Now we want to move on to the last topic related to asset, which is the returns. We know that when we want to come up with the price for an asset, we have our expected returns of holding that particular asset, and then we can use that to compute the present value, and that will be the price we are willing to pay for an asset. But in fact, when we hold an asset, eventually we should know what should be our actual return. So then we want to come up with a concept of the rate of return. The rate of return is computing the total payment you receive and then divided by the total cost that you paid, and then that will be the gross rate of return for holding a particular asset. And then so for holding a bond, the total payment you are going to receive includes the coupons, and then if you sell it, you are going to receive the price of the bonds next period. And then the cost will be the price that you pay today. So then if it is only for one period, then the return for holding a bond for one period will be the C, that is the coupon, plus that you sell the bonds, and then divided by the price you pay for it. So this will be the gross return. However, that is not the return net of the cost that you pay. So there is another concept that is the net return, which will be the above term minus 1. That is payment divided by the total cost you pay minus 1 will be the net return for holding a particular asset. How about the return for holding a stock? When you hold a stock, then you are going to receive dividend. That will be the gross return will be the D. Then you are not going to receive any more dividends. And then the price today will be how much you pay for it, and that will be the gross return. When you minus 1, that will be the net return. Basically, the net return take out the price that you pay when you get the assets, and then the denominator always be the price you pay for acquiring the assets. So this term in here and here will be the gross return, and then if we minus 1, then the whole thing will be the net return. So now let's look at an example for that. Let's imagine that you paid $200 to buy a stock of TSMC 1 year ago, and it pays you the dividends, which is $50 today, and then after receiving the dividends, you will be able to sell it for $250. Then what will be the rate of return for holding the TSMC stock? To come up with the rate of return, we can come up with the gross return and the net return. For the gross return, we get what will be the total payment we are going to receive when holding this stock. We are going to receive the dividends, and then we sell it, we are going to receive $250. Then we divided the payment we made 1 year ago. So this year's rate of return will be equal 300 divided by 200, which will be 150%, which is extremely high. How about the net return? Again, it will be high, but it will be of different number. We know we are going to receive the $50 dividends, $250 for selling the stock. However, we pay $200 for it, so we need to take that out. And then what it ends up to be is that we are going to have 100 divided by 200. So then the net rate of return will be equal 50%. So this completes the discussion related to asset pricing for this class.